Hello and welcome back to Joe Bailey Revision. Today we're going to be looking at some more businesses. Topic 1.3, which is all about putting a business idea into practice. So let's start off with aims and objectives. So what is the aim of a business? Well, it's basically the statement of their purpose. So it's where the business wants to go in the future, what goals it wants to achieve, and this can be over a long amount of time. It doesn't have to be a close thing to do, which is why we have business objectives. They basically tell us how to reach the aims, so you can do these one at a time, and it'll slowly lead up to us getting this eventual aim, which is very important, and the aim will change once it's reached, of course. And basically the objectives are stated measurable targets. This means they have a statistic behind them, like making a certain amount of money or gaining a certain percentage market share. So next, let's look at some objectives that businesses are likely to set. So some objectives are about profit maximization, so making the most profit possible, so making a certain amount of profit over what you've already got, so making a certain percentage profit more than is currently happening. Another thing is survival, which is about not running out of cash flow. This is important for new businesses due to the competitive environment of business, so they can keep running without being shut down. Another important objective is sales growth, which is about the company making more sales, like a higher percentage of sales or a higher just overall amount of sales, which helps grow the business and make it bigger, giving it a higher market share and overall receiving more money. Another objective is product satisficing. And basically all it is about making enough profit to satisfy the people who are making money out of the business. So that's the stakeholders and the owners. It's about making enough profit to make them continue to be interested in the business. So for example, stakeholders could sell their shares, but if you're making enough profit to satisfy them, they will not do that. So let's look more about objectives. So objectives can sometimes go against each other. So two of them can't necessarily work at the same time in some circumstances. So this is what we call conflicting objectives. So one example of conflicting objectives is growth versus profit. Because if you have higher sales, that might decrease your profits because you're cutting prices to try and get more of these products to sell. It's the same thing with sales. If you're having a load of sales, loads of price reductions, just at certain times, you're going to lose profit because you're selling that for cheaper than you used to say it was worth. So some other conflicting objectives are short versus long-term objectives. So basically, lower cash flows to reinvest in the business. So basically what this means is if you reinvest money in the business, it will lead to you currently having a low cash flow and having more money to spend. But you reinvest it in the business, so it will give you more money in the future. So it's about keeping more money in the long term, even though in the short term it's having a negative impact. So these things, one side goes up, the other side goes down, and sometimes you have to switch it all around. But let's keep going. So next, we're going on to costs. So there are lots of different types of costs in business. So direct costs are costs which we can link directly to a product. So this is basically your raw materials and things that are going into the actual production per individual product. And another type of costs that links to this is the complete opposite, which is indirect costs, which are basically not traceable to one product. So an example of this would be rent, because you're paying the rent for all of the products to stay there, not just for one. And these are often called overheads. It's another name for it. So two other types of costs are fixed costs and variable costs. Fixed costs stay the same throughout a certain amount of time for your business, so they're unaffected by the output. So this includes things like rent and fixed salaries, because fixed salaries will always pay the same every day. Variable costs change due to the output. So an example of this will be raw materials. If you're outputting more, you're going to need more raw materials to make that, so you're going to pay more for raw materials. However, you will get more profit, so that normally cancels it out and makes it better for you anyway. Another thing you'd have to pay for changing to output is piece rate labor. That's basically where you pay people per thing they make or per thing they do. So if they do more, they get more, which is much more complicated to run as a business, I'm sure you can believe. Breaking even is a thing in business. It's basically the total revenue, when the total revenue equals the total costs, and this means that the company can pay all of its costs and keep running. However, unfortunately, if a company breaks even, it doesn't make any profit. But breaking even is an important thing for a new business to do, as some don't even manage this and can't survive. So another thing is revenue. So revenue is basically your income over time. It's also known as turnover. So to find out the revenue, you can do the price times the quantity. So it's basically how much the thing you're selling is worth and the amount of the thing you're selling that there is. So if you had like 10 pairs of trainers and they were all £5 and you sold all 10 of them, you'd get £50 back. And this doesn't take into account the costs that have gone into it, which is why it appears so much higher than profit. So profit is basically the money remaining after the costs are paid. So this can be a minus, which would make it a loss. So the total revenue minus the total costs equals the profit. So you're basically using this, but you're taking away all the money you've put into creating your product and put into running your business. So it tends to be a lot lower. Yes. So next, let's look at cash flow. I wasn't expected to be this far so quick. So it's basically the movement of money in and out of the business. So the money going in would include things like profits, owners' funds, and loans, and the money going out would include things like wages and supplies. Which is you're buying the supplies, you're paying the wages, the money's going out, money's going in because you're putting it in physically. Net cash flow equals the money in minus the money out. So that's basically a way of comparing how much money's been put in and how much has been put out. So it compares what's invested, put in, and earned, got out. And sometimes you end up investing a lot more than you earn back. That's definitely true for newer businesses, as they have to put a load of money in just to get everything started. So next, let's have a look at how you can improve cash flow. So cash flow is improved by increasing inflows or decreasing outflows. So increasing inflows means you're putting more money into the business. So that you can do this by selling assets or using more sources of finance, which are over here and we'll get onto later. However, you can decrease outflows, another way of improving cash flow, by cutting wages or delaying bills. So let's move on to our final topic, sources of finance. This is very important. It's how you're generating the money to start your business and to keep your business running. The business can't always sustain itself, and definitely in the start it needs a lot of money going into it. So one of the main ways of this is by using owners' funds. So it's where the entrepreneur puts their own money into the business. And yes, the good things about it is that they don't get into any debt or lose any control. However, it does place great personal risk on them, as they're risking their own finances for this idea they believe in, which very likely might not take off. So another thing that you can use to get finance is retained profit. This is basically profit that's gained from the business not being taken and being put back into it, which means you're actually getting higher investment returns, so getting higher money from the business after, as we said earlier when we were talking about short-term versus long-term. And also, a bad thing about it, though, is that you have to pay more tax, which is not very good. Another way of finding finance is selling assets. You can sell things that the company's using to try and make more money. However, this could lead to a loss in sales, because if you're getting rid of like a piece of machinery that was originally used to make products, then you're losing sales because you're losing a certain amount of production and you can't make as many things. However, it is good because values of assets can change. So if the value of the asset goes up and then you sell it, you're getting a lot more money than you paid for it, which is basic business, really. Also, it reduces debt because you can't get in debt from selling your own things. Well, the business's own things. Next, let's look at loans. So we all know what loans are. It's where the bank pays you money and you have to pay them back with interest rates. However, the really bad thing about them is they have high debt, and also due to the interest rates, and also the business needs to be deemed creditworthy by the bank, which means the bank has got to think your idea will make them the money back, and it has to have a good credit score, so a good past with other banks. If it doesn't, they might fail to give it to you. But the good thing about it is you can get money quickly, so you can just get a loan, and it's done instantly. However, you might regret it due to the high debt. Another newer way of getting finance is crowdfunding. So it's basically where on the internet, a small amount of money is given from many people on a website who like your idea. So it's on the internet. And basically it brings in a load of new customers because they're seeing your product for the first time and deciding whether they like it or not, which also means it counts as market research because you're finding out what people think of it as well as them giving you money. Also, no shares are lost because you normally end up giving them products, or you send them out products after the thing. Also, but one bad thing is if the limit of money that you were asking for is not reached, the money is returned to the investors, which means you could end up with nothing at the end of the day, which could be pretty bad. The next thing we're going to look at is venture capital. So this is basically where you get a specialist investor to give money to your business. And a great thing about this is they also give their expertise. So these specialist investors know a lot about business, sort of like the people on Dragon's Den. That's basically what venture capitalists are. Also, you have to give over a percentage of ownership and lose some control and profits, which is a negative thing. But if they're going to grow your business exponentially at a really quick rate, then that's pretty good. Another thing we're going to look at is share capital. So share capital is basically when you put your product on the stock exchange. Unfortunately, this can only be done by private limited companies and bigger companies. So it would be pretty bad. You can't do this as a sole trader or a partnership, so that's one negative. Also, you lose control of your business as percentages are given away on this stock market. But a good thing about it is you're not putting any debt due to it because you're giving them the stuff back as percentages of your company. They don't want your money. Well, they do, but just in a different way. So the next thing is trade credit. So it's basically where you pay later for items, and but it can lead to a lot of debt because you're paying them back extra money than you were before, similar to loans, but not quite to the same extent. It can help improve the cash flow of a business because if you're using a lot of money in that month and you want to use less, it will still count as the next month if you're using trade credit, which can really help if you're having more money in next month than you're having this month. Also, overdrafts are our final thing. It's basically where the bank pays your debts for you when you go into bankruptcy. And it's just like loans, really. It's bad for you because you have to pay really high interest rates. However, it is really flexible and it can really help a lot of businesses in dangerous times where other things would have to happen, such as they get assets, they'd have to sell their assets, they get things taken off of them and stuff like that. That could happen if overdrafts didn't exist. So overall, they're pretty good. However, there is risk as loans, which is pretty bad. And that was topic 1.3, putting a business idea into practice. Hope you liked it. So also, I made a Discord server for Joe Bailey Revision. It's pretty cool. If you have any revision questions, you can ask them there. So, okay, thank you. Goodbye.